But equally important is what is to avoid common mistakes that would damage your financial growth. Here are some four key mistakes that investors often make. Stopping SIPs, do it yourself, invest without knowledge, falling for the narratives, and not actively participating in opportunities. So let's go through them. The biggest mistake investors make in a downturn is stopping their SIP out of fear. Market correction lowers stock prices means SIPs buy more units at lower price, which benefits you in a long run. Historically, those who continued SIPs during bear markets saw much higher return when markets recovered. As I want to say, for example, someone who stopped their SIP in March 2020, that is during this COVID, they missed out one of the fastest market recoveries in the history. So stay invested, let the compounding do its work. Do everything yourself, investing without proper research or experience can be very risky. Yes, self-learning is great, but investing based on random YouTube videos, Telegram tips, or social media hype can lead to poor stock selection and unnecessary risk. Instead of relying only on the self-study, seek expert advice. Consult financial planners or invest in a diversified mutual fund. Even when you see the experienced investors rely on expert insights. So it's important to balance DIY effect with professional guidance. Market narratives can be dangerous if they influence your investment decision without a solid research. There are some stuff like the crypto will go only up. So that's kind of a narrative we used to go through, right? But after 2021, the crypto crash, it's gone. Similarly, tech stocks will never fall. It was the kind of narrative which was there until the dot-com crash. So instead of following this market noise, focus on fundamentals, company performance, macroeconomic factors. A good investment decision is backed by data, not by hype. Correction is a golden opportunity, but many investors sit in the sideline waiting for the perfect time to enter the market. Let's be honest, right? Timing the market is impossible. Instead, those who consistently invest in quality stocks and mutual funds during downturns create wealth over time. So yeah, remember market reward actions with discipline. The best investors buy when others are fearful, and that's how long wealth has been built.